a.m. right here in Lagos, Nigeria. Good morning, good evening, wherever in the world you're watching from. It's Business Morning live from Channels HQ here in Lagos. Hope you enjoyed your weekend. Let's kick off now with what's in the news. We see oil prices edged up slightly today, supported by OPEC's plans to cut more output, while investors eye Chinese economic data for signs of a demand recovery by the world's #2 oil consumer. Brent crude futures notched up 6 cents higher to $86.37 a barrel, while U.S. WTI crude futures was trading at $82.56 a barrel, up 4 cents. Both contracts notched their fourth weekly gains last week, the longest of such streaks since mid-2022, after the International Energy Agency forecasts a record demand in 2023 of 101.9 million barrels per day, up 2 million barrels per day last year. And to the global grains market, now we see Chicago wheat futures lost ground today, with the market giving up some of last session's gains on pressure from plentiful global supplies and continued Black Sea shipments despite Russia's threats on the wartime export deal. Corn slid as the market took a breather after Friday's rally, while soybeans inched higher. Ongoing Ukrainian shipments through the U.S. brokered grain corridor, despite inspection delays and large Russian exports, have tempered immediate worries about the Black Sea trade deal. All eyes on the possible renewal of that deal. And back here, Nigeria's inflation rate has risen to 22.04% in March 2023, compared to February 2023 headline inflation rate, which was about 21.91%. According to the National Bureau of Statistics, Consumer Price Index report released over the weekend shows that food inflation rates in March 2023 was at 24.45% on a year-on-year basis, which is about 7.25 points higher compared to the rate recorded in March 2022. The rise in food inflation on a year-on-year basis caused by increases in prices of oil and fats, bread, cereals, potatoes, yams, and other tubers, with fish, fruits, meat, vegetables, and spirits. According to the National Pension Commission, no fewer than 168,768 workers have changed their pension fund administrators and moved 663.761 billion naira of retired savings accounts. PENCOM disclosed the transfers in its quarterly summary of retirement savings accounts transferred by pension fund administrators from the fourth quarter of 2022 to the first quarter of 2023. It added that 12,336 contributors moved 36.36 billion naira in the first quarter of 2022, 14,000 moved 50.22 billion naira in the second quarter, while 30,000 moved about 143.1 billion in the third quarter of 2022, while 34,000 moved 131 billion in the fourth quarter of 2022. The pension industry regulator stated that PFAs must only process requests for RSA holders registered on the Enhanced Contributor Registration System and those whose recaptured information had been successfully uploaded into the ECRs. And access to trade finance is one of the major obstacles faced by borrowers and lenders in West Africa and limiting trade on the continent. And that's the view of Dr. Ngozi Okonjo-Iweala, Director General of the World Trade Organization. She made a comment on the sidelines of the 2023 IMF World Bank spring meetings in Washington. Take a listen.
I just want to cite to you a study that we did jointly, and this study of West Africa, it showed that only 25% of the trade finance needs in West Africa are being met. This is below the average of 40% for the whole of the continent. And if we were to bring up the access to trade finance within West Africa to the overall average of Africa, trade in the region could increase by 8%. So what Makta is saying about trade finance and how do we make things real, we've got to get the supply side issues taken care of, which is part of that. We couldn't be much more important than that if we want to make also global value chains work for poor countries and poor and small and medium enterprises.
And the World Bank and International Monetary Fund spring meetings have come to an end, and a lot has been discussed. And top on the agenda, concerns over high inflation, rising geopolitical tension, and financial stability. Joining me now is Yabo Masha, Head of Secretariat and Director, G24 Washington, joining me via Zoom. Great to have you on the show.
Yes, good morning and happy to be here.
Good morning. So the meeting has finally come to an end. What were the key takeaways for you?
I think the way to look at it is that the world is going to be in a period of extended crisis, economic crisis. The projection for global growth is one of the lowest in recent times, and inflation is expected to remain high at around 7% even into next year. So what that tells me is that advanced economies are going to continue the kind of policies that they need to undertake in order to rein inflation. And once they undertake those kind of policies, like increasing interest rates and monetary tightening, then what it means for developing countries is that their economic circumstance is going to worsen. Higher debt vulnerabilities, fiscal and current account imbalances, and maybe some instability in their financial sector. So on the whole, I think it doesn't look that good, but anything could happen to change the direction that we're seeing now.
Quite a number of bleak forecasts we got from the meetings, especially for poor countries. But what do you think, poor countries can do at this time to create some kind of buffer?
So at this time, what is more important is multilateral coordination and cooperation. Most poor countries have exhausted their domestic buffers. So the idea that they can do certain things to improve on their outcome on their own is really something that has to be weighed in balance. I think that for the international financial organizations, the IMF, the World Bank, they're trying to at least play the role of, in the case of the IMF, the lender of last resort. So a lot of countries can, explore opportunities for financing so that they can have the liquidity to at least continue to operate their systems. They can, of course, approach their creditors on improving the terms of their debts and their loans to them. And at the same time, they need to make the kind of macroeconomic adjustment that will make the transition more orderly. There has to be a balance. Countries cannot engage in 100% austerity measures because then there will be no growth. And at the same time, they cannot implement 100% accommodative policies. So what they're going to do is to find a middle ground where they can at least continue to meet some of the obligations, the most important obligations, and at the same time explore opportunities from the external global environment.
And recently, the Nigerian economy was described as stable, and some Nigerians have been questioning this perspective. As the most stable economy on the African continent, we've seen FX challenges, mounting debt, inflation, reducing manufacturers' confidence, negative PMI. How do we define stable here?
Well, I think one way to put it into context is to look at what has happened, how the economy was growing in the past. So if an economy grew at around 7 to 8% annually, and it's now growing at around 3%, 3.2, 3.3, well, it is still doing better than an economy that has negative growth rate. So that, I think, is a context that you have to put into that issue. There's still a lot of activities going on in the country. It's just not sufficient to have that generalized increase in growth or increase in economic activities. But to the extent that a country is able to meet its obligations, especially to creditors, then the convention is to classify that country as stable.
And debt is definitely a big issue now for poorer countries in the world. And the IMF's decision to raise the annual cumulative limits of access for borrowings under the General Resources Account is supposed to help countries facing increased financing pressures. How exactly is this going to help?
The General Resources Account, many of the African countries do not qualify for that account. This is the facilities in this account are more for middle income and high income countries. Now, most of the ones that IMF raised the access are mainly a lot of the precautionary facilities, the kind of facilities that countries can approach the IMF at short notice and apply for these kind of facilities without any extended period of negotiation. So if a country is becoming liquidity constrained because it cannot generate enough balance of payment in its balance of payment to be able to meet its obligation, and its creditors are not extending to it the lines of credit that it needs externally, then such a country could apply for the General Resources Account, which is now around 200% higher what it can apply for. It's a bit like an overdraft, a banking overdraft, because then you have the liquidity to meet your obligations and to continue the adjustment process.
And the Global Sovereign Debt Roundtable met to discuss debt sustainability and debt restructuring challenges and ways to address them. What were the key highlights for you in that discussion?
I think what we have seen in the Global Sovereign Debt Roundtable is that there's only one test case, and that is Sri Lanka. Sri Lanka has an understanding with its creditors in which some of the creditors have decided to defer its debt service for 2 years. Some have extended the maturity. So all of that come together brings Sri Lanka's debt to a level that it can manage, that it can continue meeting its obligation. And on the basis of that, Sri Lanka now is able to qualify for an IMF facility, which was approved last month. Now, the point is that for us to be able to see how it's going to work very well, then we need to see this particular agreement work out for about 3 months. So the challenge is that other countries, like the low-income countries, they are under a different set of framework, which is the G20 Common Framework. And under that framework, no country has been able to have debt resolution because of the inability of the creditors, both the bilateral and the private creditors, to agree on the way forward for these countries. Ghana appears to be moving in the right direction, but we need to see what can come out over the next few weeks. The challenge with many of the developing countries is that it's not only the external creditors that they need to reach agreement with. Many of the low-income countries have substantial domestic debt owed to their banking system, the private sector, the pensions, all manners of debtors, all manners of creditors, and that becomes more difficult. One of the things we've seen in the case of Ghana is that in order for Ghana to be able to progress within the debt resolution framework, there has to be a write-down of around 30 to 40% of the creditor's stake haircut. So if you're having a haircut of around 30 to 40%, and the external creditors have the capability to cope with that, but domestic creditors, you're essentially cutting off the assets of the holders of those instruments by 30 to 40% of its face value. So those are the challenges we see going forward. The test case, both Ghana and Zambia, if they're able to resolve successfully, then we could look at the areas in which we can improve the framework and we can get more countries to be able to take advantage of that.
And most of these countries, the debt burden is so high at this point, and we've seen, people accuse some of these governments of not using, most of the debts they've accumulated. They've not used it judiciously to develop the economy, but they still go ahead and borrow. Is it right to still, give such countries, more loans, knowing that they're still struggling with debt?
Well, I mean, there has to be a balance. Without any financing, absolutely zero financing, such a country would go underwater, as it were. So countries need external resources to be able to finance their balance of payments, their current account in particular. So imagine a situation where there is no access to liquidity and a country cannot import, cannot do anything, then that is worse than, just conducting the kind of measures that means absolutely zero debt. I think the fine balance is for countries to, first of all, at a time like this, prioritize what they want to do, what they should be doing with them resources. And then the second issue, of course, is that if they get additional resources, then they should at least have the projects to show for it. Of course, not everything is project. Some money is spent on programs and people don't see programs and they assume that their leaders are not making the right decisions. But all in all, I mean, it's a joint responsibility. It's up to the civil society and the citizens of countries to take their governments to account and have some discussions on how the resources are being spent.
But at that global sovereign debt roundtable, the meeting referred to fairness of debt restructuring processes. What would fair look like?
The issue of fairness is really something that is used to describe the outcome for different creditor classes. So you have private creditors, like a lot of the private market bonds that countries contracted. Those are private creditors. And then you have the official debt to multilateral and regional development banks. And of course, bilateral debt is there. Maybe they owe some debt to China or to their other India, other major trading partners. What they are referring to as fairness in this case is that the outcome, the resolution, should provide the same kind of outcome for these creditors. So in the sense that if domestic creditors are going to take 30% write down, for example, the external creditors should not be in a position where they have to take 40 or 50% write down. So that in essence is what the issue of fairness is about. But it also has to be fair to the country, fair in the sense that if the country, whatever the agreed framework at the end of the day has to be set in such a way that whilst the country is able to.
And definitely, we know that debt is looking more risky at this point, with countries not able to, give us some of these loans. But we know the IMF noted that developing countries, including Egypt, have to reduce energy subsidies as the quickest way to achieve savings. In Nigeria's case, a total removal is scheduled for June. What would you say is the best way to handle this, because of the consequences?
As far as I can tell, the Ministry of Finance is handling the issue very well. They have put together some of the programs to support the removal of subsidies. And what I'm hearing is what some of the things we have seen include making some facilities available to low-income people, supporting people's income, and deployment of whatever palliatives they have in mind. So that's as much as can be done. I don't see that under the circumstance, there's much more that can be done. It's like taking a bitter medicine. It's bitter, it won't taste good, but it will cure the disease. So that's the way to look at it.
IMF's latest fiscal monitor titled On the Path to Policy Normalization. Nigeria is asked to increase tax net, but that is not the news we're getting at this time. Some believe they're saying that we should raise taxes, and we already have some people actually against raising taxes at this time. What do you think?
Maybe there's a kind of misinterpretation of that recommendation. The increasing the tax net is not the same as increasing the tax rate. When you look at the numbers from Nigeria, if we look at the corporate income tax category, for example, the statutory rate is 30%. And in many countries, it will hover around be anywhere from 25 to 35%. Now, that is a statutory rate, but when you look at what is actually being collected and you kind of come up with how much that means, what percentage that means, it's actually around 4%. So in other words, there's around 26% that is not being collected. So when recommendations are given about tax collection, it is about a country improving its tax collection framework so that it can collect more taxes than it is. That has to do mainly with the efficiency of the system. How efficient is the system in collecting what is due? Collecting what is due obviously involves fighting illicit financial flows, which is draining a lot of resources out of the country, and combating aggressive tax avoidance and evasion. So if these are addressed, then there's no need to raise the tax rate in any way because there's enough activities going on and there's enough that can be collected without increasing the tax rate. The problem with increasing the tax rate is that it only penalizes the small percentage of those that meet their tax obligations because they would then even have to pay a higher tax rate. Some of the reforms, I think last week, Nigeria announced that it has now accepted to participate in the OECD framework, which is for global corporations, and now that framework fixes a 15% minimum tax that countries would collect from, or at least that the corporations will pay the countries. Now, that is about half of the statutory rate of 30%, but when you take into consideration the fact that Nigeria is only collecting about 4% anyway, so if we're able to collect 15%, then we're talking of more than 300% increase in the tax that will be collected, which would really make a lot of difference and allow government to be able to push more money into the economy and get the economy rolling.
All right, but before I let you go, just a quick one. I want you to just look into your crystal ball. We have a new government coming in next month. Tell me, what do you see for Nigeria's economy going forward?
Well, the fundamentals of the country are still good. The country has a very high potential, a lot of unexplored areas that a new government that has the focus and that will put together a credible economic program will be very, very successful. Indeed, some of the challenges of the country are in two broad areas. That's in the policy framework, the policy design, and the second area is the way these policies are being implemented. Assuming that government is able to focus on this strongly, then there are many options on the table for the government to be able to re-engineer the economy and put it on a very strong growth trajectory.
Right.
But there are some short-run macroeconomic challenges that government has to face, and that is how to make its debt more affordable. And affordability, we're talking of really the issue of how much it has to service the debt. That is addressed once this reform of the tax framework is undertaken. So in summary, I would say that one is to have the policies and programs, which is a strategic focus, and then to have the implementation capacity, that is more of a tactical issue, and to have the leadership to implement all those very necessary reforms.
All right, thank you so much. I guess we'll leave it there now. Talking to Mrs. Iyabo Masha, Head of Secretariat and Director G24 Washington. Thank you so much for your perspective today.
Thank you.
All right, so after the break, we'll drill down on Nigeria's inflation numbers for March 2023. That's our next conversation. Just stay with us. Welcome back. It's all about inflation, inflation, inflation. And according to the National Bureau of Statistics, Nigeria's March inflation rate rose to 22.04% from 21.91% in February. The NBS disclosed this in its latest Consumer Price Index and Inflation Report. The recent figure showed a 0.13% points high when compared to February 2023 headline inflation rate. Joining me now is Dr. Afolabi Olookere, Managing Director, Chief Economist, Analyst, Data Services and Resources. Joining me via Zoom. Great to have you on the show.
Good morning. Great to have you also.
So I'm fine, thank you. And it's a new high, 22.04%. Was this in line with your expectations?
Yes. I think many people also expected an inflation should rise. And we all know the reason why. There are quite a number of things that are happening. Ideally, around elections, we always know what happened to prices. But in this particular case, the problem of election wasn't even the major source of the problem, but the cash crunch. We know what happened. People didn't have much money, even though that is also expected to have impacts on their spending power, but they were spending far more than they could have ordinarily spent. I mean, we have cases. I mean, we are also all Nigerians and we know what happened. There are situations where you want to buy things now or during that at the peak period that someone will tell you you have to add charges. So it's the kind of what they call shopping outlet bias in consumer price index, shopping outlet bias, where people may also buy at more expensive shopping outlets because of they are the ones that have the kind of things you want to be able to buy, because cash was also a major problem around that time. So it's expected that inflation will rise, and what some will even say maybe it should even rise more. But we also know that it's kind of a net effect. There are factors that will bring inflation down, and there are factors that will raise inflation. But at the end of the day, in the net, we had a positive increase in the rate of inflation.
And talking about the cash crunch, that's starting to ease right now in April. Do you think the April inflation numbers would actually come down because of the easing cash crunch?
Okay, so inflation, the way sometimes it's measured, it's also because it's annual, it's year on year, in the sense that it is going to be April against April of last year. So there are monthly impacts, but more is only the yearly impact. Another thing is that inflation can also have what they call a lag effect. Lag effect in the sense that past inflation can actually affect current inflation. So even though prices may be easing because of some of these factors, it may also imply that because of the last impact or that of February and March, you may still be having some of the lag impacts falling into April. But by the way, one would expect April inflation to come down a bit and should, maybe something lower than that of March. But another thing we should also note is that people now are able to spend more. Before now, the fact that things are more expensive, you want to transport, and the Okada man tells you, if you have cash, pay 500, but if you are transferring, pay 550, and that added the cost. That is easy now. However, people may also be able to spend more now. There probably were delayed purchases, delayed expenditure. So they can be making those expenditures now. So some of these issues are more empirical. In other words, if you look at the lag effect, if you also look at spending behavior of people, and if you also look at the fact that we are comparing prices now against prices of last year. So ordinarily, one would have expected price to ease in April, but you can never tell. There are many factors that are also in play, especially given that inflation in Nigeria is more cost push. The factor that are also, around me now, I can see some cars also queuing up for fuel, even though that has a bit eased. So these are many factors that can affect inflation as we move forward.
Level in nearly 2 decades now at 18%. Why are we not seeing the impact on the inflation rate?
Okay, so I raised an issue that inflation here, CBN knows that, and many analysts also know this. Inflation around here is often cost push as against demand pull, in the sense that it's not because people have too much money chasing fewer goods. It's also a problem, and more importantly, of fewer goods, productive capacity of the economy, absorptive capacity of the economy. Many things are around that we are not producing, that we are importing. If ordinarily we produce them, we may have lower or cheaper prices. And the cost of transportation, cost of doing business, if they are high, no amount of increase in monetary policy rate can solve that problem. They can solve the problem, like monetary phenomena are often in short term. They can have some short-term impact, but in the long run, you have no choice but to solve some of these problems. If you don't address them, if you continue to raise interest rates, a time is coming that you are going to stifle businesses who are going to be borrowing. In fact, in some principles in economics, if you continue to raise interest rates, it also contributes to the cost of doing business. it raises cost of capital, and it also fuels inflation. So one has to be careful, and the policymaker needs to find a trade-off and balance some of these things. Otherwise, some of these increase rates can be counterproductive.
And definitely the balance, it's very important to find at this time. We know salary earners, go through a lot when inflation is skyrocketing, and we're already seeing, most workers, they're asking for wage increases at this point. What do you think is the best way to handle this? Because there's an argument that if you raise wages, you're also stoking inflation.
Yeah, so it's actually a big problem. First, we have to say that inflation is always a problem everywhere. And this is not the first time we are dealing with it, and this is not going to be the last time we are dealing with this. Every economy, one way or the other, will deal with the problem of inflation. But what you just want to have is inflation that's not too high, that can also make people have a better expectation of the future and then invest. So when it comes to, that's one of the reasons why one does also praise that the new administration that will be coming will be able to solve some. We are having clamor for wage increase. We are talking about subsidy removal. We are talking of maybe making some things to be more cost reflective, looking for higher revenue, spending more. These are some of the things that the country needs. But definitely they have impact on inflation. So solution is always to be more evidence-based in our policy making.
What do you
the last?
What do you think should be the next move by the Monetary Policy Committee at the next meeting?
I would say they have to evaluate what they've done, and they have to also know that it's not just by increasing rates. I think they know that already, but because that is the monetary authority who is in charge of taming inflation, and that is the tool that it has. Well, what they should also do is to harmonize their position with other macroeconomic policymakers, especially the fiscal authority. We need to harmonize our macroeconomic policies so that we don't spend more at the fiscal side and then take the money away at the monetary side. So it's always very important for us to look at that. So MPC needs to start out what's the impact of all this, be more empirically based, and see what are the impact of some of these things on the economy. Otherwise, it can be counterproductive. But another thing they can also think about is that maybe it would have even been worse if they didn't do what they did. That is counterfactual. And some might say, oh, don't tell me what if. But it's also possible. But we need to be more empirically based and evidence-based in some of our policy making.
Right. Well, I guess the battle continues against inflation at this time. Thank you so much, Dr. Afolabi Oluokere, MD, Chief Economist, Analyst, Data Services and Resources. Thank you.
Thank you very much.
All right. Talking about inflation, now let's head to the markets, because we know how inflation impacts the markets, and we have Ini right here to unpack all of that for us. Great to have you, Ini. Happy New Week, and the battle continues.
Happy New Week on the sour note, because I think a lot of people were surprised that by Saturday evening or afternoon, we saw that inflation numbers were out. Very unusual of the National Bureau of Statistics to release inflation on the weekend.
When I'm resting. Then I get that sour news.
Inflation doesn't rest, And one of the conversation that you're having with your guests there about, are we really seeing the impact of the rate hike by the MPC? Is it really making the desired impact, which is to tame inflation? Because we keep seeing inflation increase, and now we see year on year now it's more than 16%. Month on month, I think it's worse than when you look at the previous month, January and February. It's higher now at 22.04%.
And it's quite interesting that in the UK, they're expecting single-digit inflation.
Yeah, well, that's another story. Remember Prime Minister Rishi Sunak had said that he expected inflation to taper to 2%, and then we saw it go more than 10%.
Exactly.
And
that forecast didn't work.
Yeah, but sometimes it does beg the question, do we need to create customized solutions to Nigeria's issue? And not just because we saw the US inflation taper, and we could confidently say that it is as a result of the Federal Reserve hiking rates. But we don't see the same thing in Nigeria. Time and time again, we see rates being hiked, but it doesn't reflect in the inflation. All it does is to squeeze the economy, because funds become more expensive, you know,
The
borrowing.
manufacturers are complaining.
And we still have the FX issues to face. So sometimes, I mean, sometimes it's like we need to have.
Maybe after the show, you and I will sit down and tailor something
As your chief economist,
for Nigeria.
As your chief. All right, let's go to the market now. We see the all-share index down for the week, more than 2%. Equities still at 28 trillion naira. We don't know how the market will look this week. Last week, as like the previous week, was not a very good one. Let's see other stories now. Yeah, that's the activity chart for the week. The value was almost 11 billion and about 15,000 deals for the week, 5 days. I remember that week had a lot of, you know, hypes, and we are seeing more results come out from corporates. I think we have UBA, we have GTCO. We'll see how that affects especially the banking sector at the close of trade today. See if it will lift it up and give us a little bit of relief. There, the banking sector closed in the negative, but now we have a lot of results, corporate action on the sector. Hope that will make some changes. Consumer goods was in the positive slightly, 0.05%. Industrial goods down, insurance down. Oil and gas is another place we need to look at because we've seen it unchanged, you know, for some time. Let's look at the other market now. Well, top trades. Remember Transcorp. Transcorp, we had Mr. Otedola buy 5.5% of the share, and that's rallied that stock for a bit. Charms Holding, UBA, the result is out. Perhaps that's also part of it. But let's go to the FX markets there and see how we traded. We did see that for last week, there was a lot of decrease. FX spot was down. Week on week, more than 11%. The forwards down 30% more. Futures, I mean, looking even more there. So for weekly, total of last week's was 380 million, about 380 million, and these are the daily averages. Now let's have joining us to explain a little bit about this, Dimeji Obasa is the fixed income dealer with Access Bank PLC. Dimeji, good morning. Thank you for your time. So many decrease that we saw at the FX market for last week. What does that mean and what drove that sentiment?
Good morning. Thank you for having me. What we've seen is the reduction in supply that has caused that reduction in transaction volumes. So the illiquidity of funds in the I&E window has persisted, and we've not seen funds coming to the markets to increase transaction volume and increase in liquidity as buyers continue to actively seek funds and are not able to meet their demand.
So, I mean, with the way it's going, doesn't look like anything is going to change anytime soon because, of course, we still have that FX, we see our reserves still going down. Price of oil is looking good, but our production as at last month was down, which reduced. So it doesn't look like we have anywhere to have a buffer when it comes to the supply.
Yes, well, that appears to be the case. However, the CBN still continues to try to intervene in the market as much as possible. We see that they have maintained the retail window where they continue to hold these auctions on a bi-weekly basis. In addition to that, we've had consistency with the SME and invisible, so things like PTA, medical, school fees, etc. But it still has to be said that the demand, particularly for importers on from end transactions, significantly outweighs the supply that we have in the market.
So some people have said that some of the pressure we have on an FX market is actually artificial demand, artificially created. You deal firsthand in this market. Tell us, how true or how real is this? How real is the demand? How real is the pressure? And how much of it is artificial?
So Nigeria we're an import-dependent economy. A lot of the items that we consume are imported, and even things that are manufactured here have significant inputs that need to be imported. So the raw materials have to be imported. I would not say that the bulk of the demand is artificial. A lot of manufacturers have to import their raw materials for their products, and even people who trade things like knockdown items where they assemble here in Nigeria have to import those items. So those would make the bulk of the import that we see, and as a result, the need for FX. Also, in the official markets, it's heavily regulated. So we have a situation where the items that are eligible for FX are heavily regulated, and they are tracked. So there's no way that we would say that the bulk of the demand is artificial, particularly as it relates to the official markets.
What about round tripping? How much of that is going on?
Well, the CBN has put certain measures in place to curb that by reducing the abilities of importers to buy from sources other than the original manufacturers of certain items. So we actively check that, and the CBN also ensures that everyone is in line as far as keeping the import source checked, so that you don't have a situation where importers look to round trip and buy funds from the official market and then bring it back in again.
All right, just before we let you go, diaspora remittances for this year, is it up or down? We know FDI is not looking good. What about from that aspect?
So we've seen some stability with the diaspora remittances. It's reduced slightly from last year as it relates to it coming through the official markets. However, we expect that would increase maybe going into the rest of the year and probably next year, as we've seen, an exodus of professionals leaving Nigeria, in search of more opportunities abroad. It is very likely that over time, as these, get stable in these places that they've gone to, they will begin to remit funds back to their families here, and that would then cause, an increase in remittance.
Oh, thank you so much. And sounds like a little bit of light down the tunnel. I mean, we are crying about jackpot. I mean, we can always look at the other side and say, oh, the remittances will make up for that. Well, thank you so much for sharing your perspective with us this morning, Dumeji Obasa.
Thank you.
All right, just before Ladi takes over there, you see total value of FX transactions was down also 11.53%. And unfortunately, just as our analyst there has said, doesn't look like there'll be any change anytime soon because, I mean, it's all about oil and the non-oil exports doesn't seem to be doing so well. In the NAFEX rates, in the NAFEX market, we did see an increase in the price of Naira, 0.04%. Can we see the bonds, the fixed income market, if we can have that slide just before Ladi takes over? Okay, it doesn't look like we have that time. All right, so Ladi.
Yeah,
Ladi.
so I guess one of the bright sides.
I hope you heard that from
Dimeji.
Exactly, so.
Foreign diaspora remittances.
Exactly.
Right.
I mean, so let it not all look gloom and dim. Yeah. We can have remittances to make up for some of those.
Exactly. So much to unpack at this time.
That we have lost, even though you guys
need some kind of balance.
You guys are trying to force our medical personnel to work
stay back and work for 5 years.
Let them go there and send the remittances. Perhaps that will make up for our FX shortages.
Yeah. Hopefully a fine line. Thank you so much.
Thank you for having me.
All right, so let's take a look at other markets now. We see Bitcoin there, tried to hold above that 30,000 level, did get to the 30,500 level, even spiked above 31,000, but it's kind of like moderated at this time. But we see greed in the market now, 69 points. Heavy. That's a lot of greed we're seeing right now. And at some point, it looks like extreme greed might be in the cards. Let's look at the price of major cryptocurrencies we track. We see Bitcoin there holding by a thread there, 30,000, down 1.06% over the weekend. And we see Ethereum, that's holding $2,100 at 8 a.m. this morning, up 0.18%. Did get that big upgrade. And another big upgrade coming is for the Binance coin there, BNB. $347, up 4.06%. They have a big upgrade coming for their blockchain this month. So analysts expecting that could put some pressure on the price going upward. Cardano, 44 cents, 1.90% down. And you see XRP holding that 50-cent level, up 0.73%. Let's bring in Olumide Adesina, our financial market analyst. Great to have you, Olumide.
Yeah, thanks for having me, Ladi. Yeah, good morning.
Good morning. So it looks like Bitcoin seems to be struggling at that 30K level. Could a correction be coming?
I think it's fair to say that that moderation was expected, knowing fully well that the US dollar rallied by more than 20 basis points this morning. And if you look at assets across spectrum, apart from European stocks, we could see TP reaction across these assets. So what practically is saying that, looking at the greed fear index, it tells you the momentum is still in the market. But exciting things around the crypto market. We see Dogecoin, we see rallying by 5%. Investors are weighing on Musk next move. We're seeing XRP still staying strong on the support. Time will tell if it can really break above the 50 cent mark. But just like you mentioned, the Ethereum Shanghai upgrade really took the coin above 11 months high, and we are seeing it trading excitingly still above the $2,000 mark. So it's left to be seen where investors will still rally on. But with all this excitement, we need to also be aware that the ECB they are going to have discussion today on monetary policy. So that could really weigh a bit on the market. And with building permits coming out this week on the US, we show the strength about the US economy. But pretty much, with all that said, I think a lot of investors don't want to bet against an asset that has printed 83% gain this year alone. So it's fair to see that's why the fear greed index is showing 69. So the rally is still with the bulls right now, Ladi.
And talking about a rally now, we see Ethereum holding that 2,000 level, and it is the king of the altcoins. If it stays above that level, do you see some kind of altcoin rally coming?
Most definitely, like I highlighted earlier, the fact that it plays a systemic role in smart contracts and majorly is the most traded is the most traded assets even in the crypto market because a lot of tokens are built on it, and that's because of the smart contract capability and the fact that it's less, it consumes less power, having to proof of stake. But saying these things is very tricky because, Larry, this is a very volatile market. We've seen reports from the US SEC mentioning the fact that they are going to exclusively regulate decentralized platforms, including crypto exchanges, and that definitely might have a negative impact on the long term. But, we'll see how it plays out. But I would not really want to put too much hopes on great upsides in future.
Yeah, it's definitely a wait and see moment here. But let's look at BNB now, the Binance coin. That's they're also getting a big upgrade this month for the blockchain. What do you see? How do you see that impacting the price?
Yeah, definitely. Market pundits have anticipated that the hard fork scheduled to happen on April 12th. Sorry, the previous one that happened on April 12th definitely was about improving the security and stability of the layer. So the future upgrade definitely will mean that it has more capability, and PNP also has a very big role in the space. You recall that after Ethereum, a lot of tokens also build their network on it, and it definitely you cannot ignore the fact that it's powered by the world's biggest crypto exchange in the world, Binance. So definitely, I see it having longevity in the system. But the problem we have right now is that with the securities and commodity ranking, we don't know whether the United States government will rank it as a security or as a commodity. Ranking it as a security in the long term might dampen the capability and efficiency and upside of the blockchain. But definitely, investors are really betting that the liquidity and fluidity of Binance in the system will definitely be in the favor of BNB.
Yeah, quite an interesting evolution we've seen in the crypto market. Talking about exchanges, there was a time Bittrex used to be the biggest one. You hear people say Wentrex. When are you listing on Bittrex? But now BNB is the one holding all of that space. Now, thank you so much, Olumide Additional, financial market analyst.
Thank you for having me. Yeah.
All right, so if we look at the top gainers now, we see RPL topping that counter up 15.12%, having a big run this morning. We see Phantom also on that counter up 5.16%. Flip over to the top losers this morning. We'll see who's topping the top losers counter. See Clayton there, down 6.40% at 25 cents. OKB there, token for the OKX exchange. Woo Network also on that list, down 3.16%. So still quite stable, still greedy. That's what we're seeing in the crypto market today. And that's a wrap on the program. Thank you so much for watching. Don't forget to join us by 1:30 on Business Incorporated for more updates and developments in the world of business. And you can watch this again on our YouTube channel. Flip over to YouTube, search for Channels Television, and you can watch all our productions. Have a great day. Bloody Williams. Bye for now.